Evan, is U.S. not as bad as we might have thought and the ECB thought a couple weeks ago?
Look, I think the economy in Europe is finding a bottom, and we're getting some confirmation of that with this industrial production bounce back. It's nice to see a positive surprise. The weakness has been in manufacturing, so helpful to see that. Services in general have been reasonably stable. Consumption, unemployment rate continues to go down broadly in Europe, so we think Europe is going to be just fine. In the meantime, the U.S. looks to be cooling off a little bit, not falling off a cliff, but with that, I think there's some resynchronization of growth happening in the world, and that over time I think should weigh on the dollar.
Yeah, so Mark, I'm curious about this services versus manufacturing issue that Evan just raised. I'm putting up a chart even as we speak right now. The yellow line is actually the services PMI, which is, he said, is ticking up, manufacturing going down. Which do you care about more? As you look at the prospects for growth in Europe, which do you follow more?
Well, I would say services is very important. It's a big component of what's driving the domestic economy. I would say both of them are telling us slightly different stories. Manufacturing is about the trade wars, and it's also about regulation and some of the emission standards we have re-regulated in Germany. So there's an element that the manufacturing cycle is really predominated by what's going on through the trade wars. It's happening in Asia. You can see the impact across all those different supply chains. You can see it across the PMIs for Korea, Taiwan, Singapore, those kind of countries. There's an impact that this is feeding into Europe as well. Germany's a major manufacturer for parts that go all the way to Asia as well. So for me, the biggest driver is one, it's the service sector has been stable, which is a sign that the domestic economy is holding up well. The other component is the manufacturing sector is starting to improve. So what we're seeing is Asian financial conditions are now bottoming, and they're showing a decent recovery, which in turn should lead to higher manufacturing PMIs, especially in Germany. So I'd say they're both moving in the right direction now, and the service sector is actually a good read on the domestic economy.
So actually, David has a great chart up. I'm going to steal your chart, David, because it's
put it up for you.
It's China and Europe taking a look at PMI. It's talking about slowing and being traction territory, but maybe finding the trough. So Evan, when you said that you're looking at potential resynchronization of growth, who's leading that? What does that chart look like then in 6 months?
So it's got to be China, right? China's weakness last year is really what brought down the rest of the economy, and as Mark pointed out, weighed a lot on Germany and broader European exports. As China's stimulus takes effect, and we've been waiting for it, but now it happens with a lag. We're finally starting to see it in the data. So you showed the manufacturing PMI still heading down, but a component of that, new orders, is actually ticking up. So that should be a good leading indicator that we're stabilizing here with China's manufacturing. If China's manufacturing is stabilizing, we get a healing of the trade wars and some of that domestic support coming through. That's going to filter through to not just Europe, but Japan, broader emerging markets.
So is that the way you see it? If China bounces back, then it's going to bring the rest of the world with it?
Yep, I think we've tried to take away both of the extreme scenarios. Things are positive, things are really negative, and we're kind of in a muddle along scenario. Things in the U.S. look okay. As Evan mentioned as well, like the U.S. is softening, but it's not hitting a recession. The Fed has kind of pulled everything back. They're keeping real rates very stable. They're trying to help the economy. But the focus for the rest of the world is really what happens in China. And that's really going to pull everything along. And I think when you think about how risk markets are priced, if we look at where MSCI year-over-year world was at the end of last year, it was pricing in a global recession where global PMIs were below 50. And so we're basically back to where we should be, but I think the focus over time is how much China stabilizes a cycle and how much the world can kind of resynchronize with emerging markets in Asia. Europe will come along with that trade, and the U.S. just looks less exceptional, I think, in that world.
Do you agree? Weaker dollar then, from what everyone was saying?
Yeah, I would put it in this term. So I think we're in a sweet spot for carry trades. So the G10, most of those currencies, even euro, yen, even dollar to some degree, are funding currencies. So this is where a world where G10 and emerging market drivers diverge. We're borrowing basically in all G10. We're funding and we're going into all emerging markets. Second half of the year, when we get the European growth numbers come through in the next couple of months, the euro looks much more positive because we need more volatility in the euro. So it's a second half story.